Welcome back to the deep dive. We're here to basically translate those dense corporate reports into something clear and structured for you.
Yep, that's the plan. We know you don't have time to wade through, hundreds of pages of filings.
So today we're tackling Vertex Pharmaceuticals, ticker VRTX, and their Q3 2025 earnings.
And we're not just skimming headlines, we're going deeper, using let's call it a 5-part framework, kind of like 5 key slides, to really connect the company's numbers with what the market was expecting.
Our goal really is to get behind the numbers, understand the why. Vertex had solid revenue growth, no doubt.
Absolutely. Top line looked good.
But the profit growth, much slower. And that gap tells a story, doesn't it?
It really does. It points to this big strategic shift they're making. Their main drug franchise is maturing, which is natural.
Right.
So they have to invest heavily in new areas, like their gene therapy, CSGVY, and this new pain drug, JournavX.
It feels like a real turning point for them, trying to move beyond being just the CF company.
Exactly. It's a classic biotech pivot. And Q3 shows how successful that's starting to be, but also how expensive it is. That investment piece is key.
Definitely need to look at where that money's going and if it makes sense long term.
Yeah. Are they making the right bets?
Okay, let's dive in. First section. Now for slide 1, the at-a-glance scorecard.
Right. This is the headline view. How did they do compared to last year? And maybe more importantly, how did they stack up against Wall Street estimates?
So year over year first. Top line, revenue came in at $3,076.4 million. That's up a solid 11.0% from $2,771.9 million in Q3 last year. Pretty strong growth still.
11% is definitely not bad for a company their size. But, like you said, the bottom line, that's where it gets interesting.
Yeah, net income only grew 3.6%. It went from about $1,045 million to $1,083 million.
See, that's the gap right there. 11% revenue growth, but only 3.6% profit growth. That immediately tells you costs went up significantly faster than revenue.
Points straight to that investment cycle we mentioned.
Definitely. But even with that lower profit growth, they did beat what analysts were expecting, right?
They did. The revenue of $3.076 billion was ahead of the consensus, which was around $3.05 billion. So a clear beat on the top line.
Okay. And EPS, earnings per share.
Also a beat. They reported non-GAAP diluted EPS of $4.80.
Ah, non-GAAP.
Yeah. And the street was looking for $4.56. So a pretty comfortable beat there, too.
And it's worth pausing on that non-GAAP thing. For biotech especially, that's the number analysts really focus on.
Right. So maybe explain that for our listeners. Why non-GAAP? What's the difference and why is it the standard here?
Sure. So GAAP, generally accepted accounting principles. That's the official rule-based number. It includes everything.
The legally required stuff.
Exactly. Non-GAAP is management's adjusted view. They basically say, okay, let's pull out certain items we think distort the picture of our core day-to-day operations.
Things like one-off charges or non-cash expenses.
Precisely. Often it's things like amortization from past acquisitions, restructuring costs, or a big one this quarter, stock-based compensation. The idea is to give you a cleaner look at how profitable the actual business of selling drugs and running R&D is quarter to quarter.
Makes sense. Kind of like looking at the underlying engine performance without, accounting noise.
That's a good way to put it. Allows for better comparisons over time and between companies.
Okay, let's also quickly touch on basic versus diluted EPS. The GAAP number was $4.20 for both this quarter. What's the key difference?
Basic EPS is simple. Net income divided by the actual shares outstanding right now. For Q3, that was 255.6 million shares.
Straightforward.
Diluted EPS is what investors almost always use because it's more conservative. It uses a higher share count, 257.6 million in this case.
Why higher?
It includes all the potential shares that could be created if things like employee stock options were exercised. It shows the earnings per share in a sort of worst-case dilution scenario.
Got it. So it assumes all those potential shares are shares?
Exactly. Now, here's a really interesting point connecting back to those growth rates. Net income grew 3.6%, right?
Right.
But the diluted EPS grew faster, 4.7% year over year. How does that happen?
The earnings per share grew faster than the total earnings. That must mean the number of shares went down.
Bingo. That's the share repurchase program in action. They're using their cash to buy back stock.
So they're shrinking the denominator in that EPS calculation.
Precisely. The diluted share count fell from 261 million last year to 257.6 million this year. It's a way for cash-rich companies, especially those not paying dividends like Vertex, to return value directly to shareholders.
And it also signals management thinks the stock is a good buy at current prices.
It definitely does. It's a confidence signal while they invest heavily in that R&D pipeline for the long haul.
Okay, that tees up the next question perfectly. Why did profit growth lag? Let's look at the costs. Moving to slide 2, the engine of profitability.
Yeah, this is all about margins and efficiency. Was that gap between revenue and profit growth planned, or was it inefficiency?
Well, the numbers confirm the margins definitely got squeezed. GAAP operating margin fell from 40.3% last year down to 38.6%.
Okay, a noticeable drop. And non-GAAP.
Same story, basically. Non-GAAP operating margin went from 47.2% down to 45.0%. So both measures are showing that compression.
Right, so it's a real trend. And the reason, as we suspected, is costs growing faster than revenue.
Yep, total costs and expenses jumped 14.2% year over year, significantly outpacing that 11.0% revenue growth.
But critically, the company frames this as strategy, not slippage.
Exactly. The press release specifically calls out two main drivers for the increased spending.
Let me guess, R&D and SG&A.
You got it. Higher R&D for clinical programs and higher SG&A selling, general and administrative, mainly to support the launch of VRTX, that new pain drug.
So they're consciously choosing to spend more now, hitting near-term margins to fuel future growth.
That's the narrative. Investing in the pipeline and the new product launches.
It's the classic growth biotech playbook, isn't it? You have to spend big on R&D. The risk is always there. What if these bets don't pay off?
Especially without a dividend cushion for investors.
True, but that's where their massive cash balance comes in, which we'll get to. They can afford to take these calculated risks because they believe the potential payoff from a new blockbuster outside of CF is huge.
Makes sense. Let's quickly revisit that GAAP versus non-GAAP difference again in the context of spending. The big exclusion for operating income was stock-based comp, right? Almost $195 million.
Yeah, $194.9 million. That's a huge number. And stock-based compensation, or SBC, is basically paying employees with stock or options instead of cash.
So it doesn't drain their cash pile today.
Correct. That's why management often excludes it for non-GAAP. It's a non-cash charge in the current period.
But it's still a real cost long term, isn't it? It dilutes existing shareholders eventually.
Oh, absolutely. It's a trade-off. But in biotech, attracting and keeping top-tier scientific talent is everything. Your company value depends on your pipeline, which depends on your scientists.
So you have to offer competitive packages, often heavy on equity?
You really do. That nearly $200 million in SBC isn't just fat. It's the cost of acquiring and retaining the brains needed to discover the next big drug. It's a strategic necessity in this sector.
Okay, so if the spending is strategic, let's see where the revenue supporting it is coming from and where the investment is going. Now for slide 3, the engine room business segment performance.
Right. Let's break down the revenue. Where's the money coming from now, and where might it come from in the future?
Well, no surprise, the absolute giant is still Trikafta, their main CF therapy.
The cash cow.
Totally. Generated over $2.65 billion just in this quarter. It basically funds everything else.
It's a monster product. But what was the growth rate?
Yeah, that's the key part. Only 2.7% year-over-year growth for Trikafta.
See? That confirms it. It's maturing, still incredibly profitable, generating huge cash flow, but the explosive growth phase is over for that specific drug.
Which underlines why they need these new therapies to work.
Exactly. The diversification isn't optional. It's essential for future growth.
But they're also innovating within CF, right, with Alyftrek.
Yes, and that launch looks really successful. Alyftrek brought in $247 million this quarter.
And that was zero last year, so that's all brand new revenue.
Right. It's their newest CFTR modulator aimed at extending their leadership. Hitting nearly $250 million in revenue so quickly shows strong uptake and really solid commercial execution within their core market.
Okay, now for the really interesting part. The diversification plays hiding in that other revenue category. Overall, that category actually declined 5.9%.
Yeah, which sounds bad at first glance, but it's mostly just cannibalization.
Meaning patients switching from older CF drugs like Orkambi to the better ones like Trikafta or Alyftrek.
Exactly. They're swapping out lower margin old revenue for higher margin new revenue. Smart life cycle management.
But buried within other are the seeds of the future, Casgevy and JournavX. The numbers are still small.
Tiny, relatively speaking. Casgevy, the gene therapy, did $16.9 million. JournavX, the pain drug, did $19.6 million.
So less than $40 million combined. Seems insignificant next to Trikafta's $2.65 billion.
In terms of current revenue, yes. But strategically, they're hugely important. These are the proof points.
Proof that they can actually launch and sell products completely outside of CF.
Precisely. StockAnalytics.ai shows they can navigate the incredibly complex world of gene therapy commercialization. VRTX, with, what was it, over 300,000 prescriptions filled?
Yeah, that's what the release said.
That shows they can actually penetrate a massive competitive primary care market like non-opioid pain. These aren't just R&D projects anymore, they are generating revenue in new areas.
So the small numbers today are indicators of potentially massive numbers tomorrow if they execute well.
That's the bet. They're using the CF cash machine to fund these launches and the next wave of R&D. It validates the whole diversification strategy is actually working, step by step.
Okay, that strategy requires deep pockets and a strong financial foundation. Let's look at that next. Moving to slide 4, financial strength and shareholder rewards.
Right. Given the heavy spending and margin pressure, how solid is their financial footing? Can they sustain this investment?
Well, the word fortress comes to mind. They ended the quarter with $12 billion in cash, cash equivalents, and marketable securities.
$12 billion. That's just a massive safety net.
Huge. It means they can fund all this R&D, all these launches, without needing to borrow money or issue more stock, really. They have complete independence.
Total financial flexibility. That cash hoard is also dry powder for potential M&A if the right opportunity comes along.
And their debt levels confirm that strength. The debt-to-equity ratio is super low, only 0.44.
Wow, yeah. Anything below 1.0 is considered conservative, and 0.44 is very low. It means very little leverage, lots of borrowing capacity if they ever needed it, which they clearly don't right now.
So financially, they are incredibly secure. Now, how are they rewarding shareholders given that strength? We know no dividend.
Right, typical for a high-growth biotech, reinvesting heavily, so it comes back to the share buybacks we discussed earlier.
That's their main lever for returning capital.
Exactly. The press release even noted that cash grew despite being partially offset by those repurchases. It shows a commitment to returning some capital while prioritizing reinvestment in the science, which they believe offers the best long-term return.
So the message is, we're strong, we're flexible, and we're betting big on our own pipeline, using buybacks to provide some shareholder return along the way.
That sums it up pretty well. Confidence backed by a very strong balance sheet.
Okay, let's bring it all together and look ahead. Now for slide 5, the road ahead management's outlook and key takeaways.
This is where we connect the dots. What did this quarter's performance lead management to say about the future? How are they guiding?
Well, the CEO, Reshma Kewalramani, her comments basically reinforce the strategy. Keep leading in CF, build momentum for QCAS-TVY globally, and push the JourneyVX launch hard.
Sticking to the plan, no major surprises there.
But the updated guidance for the full year 2025 had some really telling details. First, revenue guidance was tightened.
To what range?
$11.9 billion to $12.0 billion. A very narrow band.
Which suggests this late in the year, they have high confidence and predictability in their core CF business. They know roughly what it's going to do.
Right. But the big move was on the expense side. They actually raised their non-GAAP operating expense guidance.
Raised it. Interesting. To what level?
To $5.0 billion to $5.1 billion. So they're planning to spend more than they previously thought.
And that's actually a bullish signal, isn't it? It means they're seeing positive developments that warrant putting more fuel on the fire.
Exactly. Management isn't raising spending guidance because things are going badly. They're doing it because things are going well or ahead of schedule.
And did they say specifically where that extra money is going?
Yes. 2 key areas mentioned. First, acceleration of povetacicept programs in R&D.
Povetacicept. That's the big one for kidney disease, right? APO1-mediated kidney disease.
That's the one. A potentially huge market, much larger than CF. Accelerating those programs means the clinical data must look promising.
Yeah, you don't spend more money to speed things up unless you like what you're seeing. That's a major vote of confidence in that pipeline asset.
And the second area for increased spending.
Let me guess. JourneyVX launch support.
Bingo. More sales and marketing investment for JourneyVX. Again, suggests the initial launch is exceeding expectations and they need more resources to capture that demand.
So, both R&D acceleration on a key pipeline drug and increased commercial support for a successful new launch. That's why the market likely sees higher spending guidance as a positive here.
And there was one more boost. They lowered their expected tax rate for the year.
Whoa, how much?
The non-GAAP effective tax rate guidance dropped quite a bit, from around 21% down to 17–18%, due to some one-time benefit.
Okay, so that helps the bottom line directly, offsetting some of that increased operational spending.
Right. So if we boil all this down, what are the main takeaways for listeners?
Okay, I think there are three key ones. First, the quarter's beat was real, driven by solid CF execution, but importantly, boosted by those early tangible results from the diversification efforts, Elictrac, Casgevy, Journevex.
Takeaway 1. Execution and diversification starting to pay off. Got it.
Takeaway 2. The margin pressure and the increased spending guidance aren't bad news. They reflect a clear strategic choice to invest aggressively in the future, specifically accelerating povetacicept and capitalizing on Journavx's early success.
Takeaway 2. Strategic investment driving near-term costs, but signaling long-term confidence. Okay.
And takeaway 3, they're managing their capital smartly, balancing that heavy R&D spend with shareholder returns via buybacks, all from a position of incredible financial strength thanks to that fortress balance sheet.
Takeaway 3. Shareholder-friendly capital allocation alongside focused R&D. Makes sense.
So, the overall story of Q3. It feels like the quarter where Vertex's big strategic pivot started to show concrete results. They're managing the CF maturity, launching new drugs successfully, and investing heavily in the next wave, all with a ton of cash in the bank.
Yeah, and hopefully using this structured approach, you, the listener, can see beyond just beat or miss and grasp that underlying strategy.
It's definitely more complex than the headlines suggest.
Which brings us to a final thought. With management doubling down on povetacicept for kidney disease and Journavx for pain, which of these new non-CF areas do you think has the best shot at becoming the next multi-billion-dollar franchise for Vertex over, say, the next 5 years? Is it the rare disease gene therapy route or the big chronic disease market?
That's the multi-billion-dollar question, isn't it? Povetacicept's market potential is theoretically massive if it works. But Journavx is already out there generating prescriptions. It's a fascinating strategic race to watch.
Indeed. A great point to ponder. All right, that wraps up our deep dive into VRTX Q3 2025.
Hope the structured look was helpful.
Disclaimers. Not financial advice. Do your own research. Generated by AI.
Like and subscribe to StockAnalytics.ai. YouTube channel members get access to our library of S&P 500 stocks and NASDAQ 100 library we're building out, and also get priority requests for company deep dives.